Howdy, welcome back to Dion Talk. This is going to be a nice short live stream that I do on my phone. So during this live stream, I won't be able to answer any questions, but I will answer questions in the comments below after this live stream. If you want to come and get questions answered live, every Tuesday at 4 p.m. Pacific, I do a live stream that lasts as long as the questions do. This video is going to be focused on a huge warning for investors, and I want to help you not make the mistakes that are causing these problems. There's 3 mistakes that people are making that made me want to make this video. The first one, and it's one that really lines up with my content very well. If this is your first time to my channel, my goal is to help the average individual realize that you can reach financial freedom and make work completely optional, even if you're not starting from the best position. That's what I did. It took about 8 years to reach financial freedom. I kept working for another 4 and recently retired. But we're coming up on a recession. And there's these 3 mistakes that investors are making that I'm trying to get people to understand. The first one is one people have been making for about a decade. So this isn't something new that we're going to all of a sudden find out about. For about a decade, a lot of people have been waiting for the crash or the correction. In 2008, we had one of the largest housing crashes, well, pretty much the largest one in my life, which a lot of people were expecting to happen again, especially around 2012 and 2013 when prices went above where they were in 2008. So almost every year since 2012, there's been a reason for the crash to happen. So investors were waiting for the crash or the correction to happen, missing out on years of cash flow, appreciation, principal pay down, all the benefits of investing in real estate. Especially in years like 2020. So around 2018, we had interest rates jump up. We had prices finally surging above 2008 levels. We had a pandemic. We had an eviction moratorium. We've always had reasons for the crash or correction. And what we've heard now is prices are going up and then interest rates are going up. So there has to be a crash or a correction. So people are waiting. So that's the first mistake people are making coming into this recession is a decade of not investing in cash flowing assets. The biggest fear I would have at a time like this would be relying on a W-2 income as your only source of income. And it doesn't take a lot of rentals. I only have 7 properties with 16 units. With those 16 rental units, I'm able to generate enough money coming in every month that I don't have to sell my life 1 hour at a time for, to where I was able to quit my job. Because I've been investing for 10 years. If I had been waiting for the crash or correction like a lot of people, I'd be coming up on a recession where I needed my job, and if I got laid off, just like everybody else in that same position, unemployment only lasts so long. So that's the first mistake, is waiting for the crash or correction. I'm hoping that if you're watching my content, you're not the people that have been doing that. Or we've at least been able to start you on your journey to get you investing so that you can make work optional too, and be more prepared for a recession. And then a lot of people will talk about, if you invest, the recession can actually impact your real estate portfolio. And that is true is if you haven't invested with a strategy planning on having a recession or a pandemic or a stock market crash. And I talk about this often in my content, is I've diversified my properties by investing in small multifamily and keeping them at least 10 miles apart. All but 2 of my properties, they're about 7 miles apart. I've done that so that I'm drawing tenants from different economic drivers, things like a base, a port, a college, a hospital, a Boeing or Amazon terminal, or a large population. And then I diversify my tenant base. So I have about 1/3 military, 1/3 Section 8, and 1/3 working or retired. So when one sector of the economy is impacted, I am not losing out, and I'm not over leveraged. I can literally handle a 50% rent decrease without having to dig into my own money to pay mortgages. And while I've planned for a rent decrease and I've planned for a recession, since we started tracking the data in 1914, there has never been a time where rents decreased in Class C or B neighborhoods. Every 5 years they've tracked the data, rents have continuously gone up. I still planned a portfolio around the idea that rents could go down. So that's the first mistake. If you haven't been investing, you're not as prepared for a recession as you could be. And if you do invest, you need to invest in such a way to where you're planning on something like a recession. The second mistake, and this is a mistake that investors are making now, this mistake is waiting for interest rates to come down to buy. And I don't want to name anybody specific, Adam, but if you said things to me like this, like, I want to invest, so as soon as interest rates come down, I'll be able to borrow money at a cheaper rate and buy a property. The lack of logic in this thought is stunning to me, because people have said if interest rates go up, prices come down, which is not true. Buying power goes down if interest rates go up. The last time that interest rates doubled in the 1970s, prices almost tripled. because interest rates are just one factor. Wages actually set prices, and we're seeing record wage inflation. And it's not really from people getting raises from their boss, it's more from people getting raises from this thing we're experiencing called the Great Resignation. Over 4 million people a month, pretty much for the last year straight, have left their jobs, but unemployment is under 4%, which means they're not leaving their job to go on unemployment. They're changing companies, which usually equals a large increase in wages. So we've seen prices go up. So if interest rates are going up and prices are going up, saying something like, I'm going to wait for interest rates to come down so that I can afford to buy a property and then jump into this real estate game, here's why there's a flaw in that logic. If interest rates go down, people's buying power goes up, which means prices would increase. But let's just say, magically, somehow you live in la la land where if interest rates go down and prices go down, you can now afford to buy your property. Here's where the huge warning to investors comes from. This is the thing where, this is the mistake I think a lot of people are making.
Hey, look, it's that Dion Talk guy.
I'm like by myself out here. I'm a ventriloquist. If you're making this mistake, this is what's going to get you in trouble with a recession. Let's say you're waiting for rates to come down so that you can buy, which means prices would go up. But if they don't, prices come down and now you can afford to buy the property. You're probably not going to be able to. Because right now, for the last 2 years, what we've experienced is called quantitative easing. The Fed has a couple of tools when it comes to fighting inflation. The first one is interest rates. And yes, interest rates go up and down to whether they're trying to make inflation go up to, or motivate the economy or bring inflation down, they'll increase rates, which they've been doing. But we've seen quantitative easing, which most people understand the first step of this. The first step of quantitative easing was helicopter money. We printed $120 billion a month for over a year. We gave out stimulus, unemployment, extra unemployment, extended unemployment, PPP loans in the millions that were then forgiven and didn't have to be paid back. So all of this extra money is part of the quantitative easing. Most people and most investors understand that. They've seen it. They saw the inflation that caused. What most people don't understand is that quantitative easing also involves the Fed owning assets, keeping assets on their books. So they will take on more Fannie and Freddie backed loans. They will own more assets that the lenders don't have to carry on their own books. So lending criteria isn't loose. We don't have ninja loans. We don't have no income, no job, no asset loans. We don't have 105% loan to value loans going out. We've got tighter lending for the last few years, but not as tight as it's going to get, or as tight as it was in 2012 to 2015. In 2012 and 15, when prices were down from the 2008 levels, people couldn't borrow money. Even imagine being in the position of somebody like Michael Zuber. Successful, had a 6-figure job, had a successful rental portfolio with a track record of rental income on his tax returns, and was not able to get money from a bank. That's the position a lot of people are going to find themselves in. They're going to say things like, now that interest rates are down, I can afford to buy a house. So they'll go to their bank, and the bank is going to say, your debt to income ratio isn't good enough. We can't loan to that loan to value with you, with your work history. Right now, we're able to get 10 loans in our name with conventional lending, but it's possible that lenders will change it to the way it was from 2012 to 2015 to where you can get 4 loans in your name. Imagine if you had 6 mortgages and you wanted to add the next property and everything looked good, but the lender said, you can't borrow because you have too many mortgages. You're only allowed to have 4. So the economic event that could cause the interest rates to go down for you to be able to buy the property you're looking at could be the economic event that makes it to where it's not possible for you to borrow the money to buy that property. And today, the slides are not wet, but they're hot. 3 mistakes that people are making. Let me ratchet them off really quick. The first one, waiting to invest and spending the last decade not acquiring cash flowing assets to be ready for something like a recession. Second, waiting for interest rates to come down, which is only going to increase the buying power of other investors. And your competition is going to be paying more for the same properties that you're looking for. And the third is not understanding quantitative easing is switching to quantitative tightening, and the lenders are going to disappear. I hope this helps you in your investing journey. Until my next video, thanks for coming to my Dion Talk. Thought I was going to die on the slides, but not today.